Thank you so much for taking part three of Military Consumer Toolkit class. Part one was spending and budgeting. Part two is earn. Part three is borrow. Part four is save and invest. And part five is protect. Each video in the series has a 13-minute introduction that is the same as on video one. And thanks again and have a great day. This is the introduction to this particular video, and it talks about why the Military Consumer Toolkit was created, its purpose, and how it will help military families, and why this matters so much to the Federal Trade Commission and the military. My family has served in the military. My uncle was in the Navy during the Korean conflict, and my stepfather was in the Air Force for 30 years. My husband was a Marine. My daughter was a Marine, and she served in Desert Storm. I wanted to serve in the Marine Corps, but that didn't come to pass. I'm small and sickly. So, but I just want to try to give back to those I care about so much. And so I put this video together to be of assistance to our military family and friends. So once again, thank you for watching this video. I had a joining forces video in this segment of this video, and I've had to take it out because of the music or something on YouTube. It was copyrighted, so I just took it out. I am saddened to know that the website is no longer active. We still need the resources that was provided by this organization. Even though it was an initiative started by Dr. Jill Biden and First Lady Michelle Obama, it is still needed. I hope someone out there listening to this video will move this wonderful organization to the private sector, all of the businesses and all the people that were involved in the companies. I know there's protocol and everything with various administrations and all of that stuff, but it just is mind boggling to me that this administration has removed this website and all of the things that were being done for our military families. So if there's someone listening, please do something. Maybe you can talk to Ms. Obama if you're in that area, or Dr. Biden if you're in that kind of area. But this needs to be reinstated in the private sector, in the communities at large. It does not need to be an initiative that can be turned on and off because the needs are not turned on and off. I don't know what I can do. I'm just a lowly retired person, but those that have power, this is one time you could use your power for great things. Absolutely great things. Debt can put you in a cell. It can put your mental life in a cell. It can affect your family, your requirements on the base. It can just have so many negative side effects. And the only way to fix that, the only way to correct it and to get out of the mental anguish of debt is training. That's what this video is all about. That's what the toolkit is all about, to give you the tools and the abilities to get yourself out of the situation and not find yourself back in a mental lockdown because of debt.
I'm Jessica Rich, Director of Consumer Protection at the Federal Trade Commission.
And I'm Technical Sergeant James Mulhern.
When the Department of Defense said that financial readiness is a big part of military preparedness, we listened. When you know how to manage your money and how to spot a ripoff, you're more financially solid. That keeps you mission ready at home and abroad.
That's why the Department of Defense, the Federal Trade Commission, and others teamed up to make military.consumer.gov your tool for financial readiness.
We are proud to offer our uniformed service members and families quick mobile tips that won't slow you down. Want to buy a car, manage your money during deployment, or continue your education? Get started right from your phone at military.consumer.gov.
Before you open your wallet, check out Military Consumer.
For all our members of the uniformed services, knowledge is the first line of defense for you and your family. Visit military.consumer.gov, your tool for financial readiness.
What you want is not always what you need. Sometimes that new car should not be a purchase, whereas you can actually fix up the old one you have, maybe a little body work, a little paint work, and that will keep you from adding additional debt that you cannot afford. The purpose of this class is to help military families and military personnel to have good tools to make good financial decisions, because wrong decisions can have a long-term effect on family life, mission readiness, and the service members' security clearance. Working with the Department of Defense, the Federal Trade Commission came up with this program, and it's so important because they want you to be able to make solid financial decisions that will not impact you and your family in a negative way. This program seeks to help you answer these questions. Who will handle my finances during deployment? What should I know when buying a car? Often we think that's an easy purchase, but some of those contracts can be detrimental to your finances and can cause you some serious financial harm. And also, can I use my military training to further my goals? As you saw in the video from joining forces, that is very relevant and possible. Why does this matter? Why is this so important? Why does the military seek to help those families and personnel to understand more clearly the concept of debt? It's because of the survey they did and the studies they have found that the average military family has more debt than assets. The purpose of this class is to help you, give you the tools so that you can make good decisions on your assets and not acquire a lot of debt. Continuing with why this matters. The challenges of military life can affect the service member's finances as well as the service member's family. It hurts everyone when things are off balance. Frequent transitions and changes can cause you to have problems straightening out different debts and obligations in one location when you move into another. Many service members have little financial experience. That was my father. When he came into the military, he was taken advantage of. I know of a couple of car purchases he made that really did not turn out well. And the bad part about it, these things have long-term consequences. These things can follow you when you leave the military. This whole program is designed to give you the know-how and the keys of making good, smart financial decisions. This is the section on borrow. This section is about borrowing money, not always a loan, but not always directly. Sometimes how we use credit creates a borrow situation because you're not paying cash. Anytime you're doing things on credit, you're actually borrowing money. You're creating a debt.
Great pizza.
Is it worth $2,000?
Huh?
I didn't say anything.
I did.
Who are you?
I'm the credit card you just used to pay for that $2,000 pizza.
What are you talking about? It only costs $9.95.
Yes, if you paid it off within the grace period. But you only pay the minimum due. And you've almost maxed out your $500 credit limit, mostly on pizza and other impulse purchases. So, if you just keep paying the minimum, it will take you 267 months to pay me off. And all those little charges will wind up costing you $2,129 based on an 18.9 annual percentage rate.
We better enjoy this pizza. You'll be paying for it for 22 years.
I wouldn't talk if I were you.
Who's that?
Uh-oh. That's my credit card.
That's right. And you owe about $3,000 on me.
That's not so bad, is it?
No, except you only make the minimum payments too. That means you'll be paying for that smartwatch about 2 decades after it's gone out of style. By then, that $3,000 balance will have cost you $12,774 based on your annual percentage rate, which is also 18.9%.
So you're saying we shouldn't use credit?
Oh, not at all. Credit cards are a powerful tool when you let them work for you.
Credit cards are handy and safe for online purchases, and we can be a lifesaver in an emergency. We help you establish the good credit that will help you purchase important things like a car or home.
Use credit within your budget and try to stay away from impulse purchases.
Like food?
And clothes?
It's fine to use us for a special celebration.
Or to buy a suit for an important interview.
But remember to think before you spend and stay within your budget.
Here are some simple guidelines for managing your credit.
It's okay to have credit cards, but manage them responsibly.
And you really need to pay your bills on time.
Keep your balances low on credit cards and other revolving credit.
Pay off debt rather than moving it around to other credit cards.
Don't open a lot of new accounts too rapidly.
And finally, check your credit report often.
Remember, keep your credit working for you.
And not the other way around.
Being smart about using credit cards. As we saw from our little pizza experience, if we're not careful, we can end up with a $2,000 pizza. Well, we need to know the risk of credit cards. Carrying a balance. As you saw from that experience, when you carry a balance and you don't pay it off and you only pay the minimum payment, the bulk of the money you pay goes towards the interest, not the principal. So you end up paying for a $2,000 pizza. So the main thing you want to be able to do each month is to pay off the balance that's on the card. Many times that's how we get in financial hardship, because we can never get that balance paid down. So every little dime we put on the credit card is just being eaten up in the interest payment. Missing payments, that's not an option. If all you can do is pay the minimum payment, pay the minimum payment. Just keep that bill paid every time, every month, the exact amount of the minimum payment. You don't want to miss a payment, because that will affect your credit negatively. Now, before you get a card, you want to look into some things. You want to make sure about the annual fees and other fees. Some credit cards have a fee for use, that you use the card every year. They actually charge you for that. And then other times you have late fee costs, you have overage costs, and all of these. These are all explained in that little contract you get with that point 2 font. So you want to make sure you read this, or at least before you get the credit card, have the company explain all of the fees to you. There's usually a little short document that talks about the fees. Now, the APR is the amount of interest rate, is the annual percentage rate, and it's the cost of using that credit card expressed in a yearly rate. Now, the yearly interest is the amount of interest you've paid over the year, which can actually sometimes be more than you've paid on the principal. I know of a person who has a car, and his truck payment is $500 a month, and I was helping him with some finance issues and explaining some things, and when I looked at his statement, he's actually paying $250 a month on the interest and only $250 on the principal. So it's going to be a very long time for him to pay that truck off, and the amount of money he would have spent on the truck is almost the double the value that he paid for the truck. Grace period. This is usually the time that they give you before you pay interest. Say, for instance, it could be 25 days. If you pay off the face value of the card, then there's no interest, none. But if you pay after that, then the interest accrues on your account. And so the payment you make will be minus the interest, and then the balance will be paid on the credit card. Incentives. The incentives you have are sometimes little things like, say, for instance, they will give you miles towards flying, or little gifts or little discounts on things. And sometimes these things are not just worth what you buy. So you want to make sure that sometimes the incentives will actually make you use your credit card more because you're trying to run up all these miles for something you think you're going to have. Now, the monthly payment, as we discussed, is the amount you pay each month. And basically, if you can, pay off the credit card. But being absolutely honest, very few people actually do that. And people who are struggling with money problems rarely do it. And often we will take out more credit cards because we struggling, and that is the worst thing you can do. But as I said before, if you make the minimum payment, at least this will not affect your credit rating or your credit report. So, but go talk to a financial counselor. Come up with a way to get rid of the credit card.
David didn't like carrying cash around after payday. He wanted a different way to pay for things, but he didn't want a bank account or credit card. So David decided that a prepaid debit card would solve the problem. He could load money on the card and use the card to buy things. David found a bunch of prepaid cards at the store. He chose the card recommended by his favorite singer. He loaded $200 on the card and went shopping. But when David checked his balance a few weeks later, he got a surprise. He didn't know he paid $10 to activate the card, $12 a month to maintain it, $3 every time he bought something, $6 to check his balance, $3 to get cash from an ATM, $4 to get his statement in the mail, $2 to talk to a customer service agent, and $3 to reload the card. David loaded $200 on the card, but got to spend only $157. So David did some research and found a prepaid card with lower fees. He got rid of the first card and switched to the new one. He's much happier now.
Back, but you can't. Okay, prepaid debit cards. As we saw from our experience with David, he was having some issues. So we're going to look at some of the pros and cons of these cards. On the pro side, you don't need a bank account or strong credit. You can have really bad credit, and you can get these cards, as you saw David, and put money on them. And some may have overdraft features, but you want to be careful of that too, because if you overdraw on the card, it can suck the rest of the money off you put on next time, because the fees can be very high. The cons, it doesn't help with your credit history. And as I said a minute ago, it can have some very high fees and a lot of hidden fees, as you saw, that you had to pay to look at how much your balance is. They took off money for that. So you have to be so careful. But when you decide on doing this, if you want to decide to get one of these, you want to shop around. You don't want to just take the one that's being recommended by someone, maybe you know, or an entertainer like he did. You want to actually check the fees, what the card does, what it charges. So you also want to look at many complaints you might find on many consumer protection website. So, and then you want to also be careful because you get no consumer protection. That's why you want to check the consumer protection websites to find out any problems that the company may be having, because if the company go out of business, your money just gone. That's one of the non-consumer protection issues you would have to deal with. I want to borrow some money before payday. Who do I ask? It sure adds up at the end of the month. Well, what adds up? All of the little fees that we saw David going through, that's what adds up. So you have to be careful where you get money.
Just like a taxi is meant to take you on a short trip, payday loans are meant to be short-term debts. These are small dollar loans that are usually due in full on your next payday and carry an average annual percentage rate of over 300%. Most consumers can't afford to pay back all of the money they owe by their next paycheck. Within a month, almost 70% of borrowers take out a second payday loan. 1 in 5 borrowers ends up taking out at least 10 or more loans, one after the other. With each new loan, the consumer pays more fees and interest on the same debt. What was supposed to be a short-term loan becomes a long-term debt trap. That's like getting into a taxi for a ride across town, but paying for a cross-country road trip. The Consumer Financial Protection Bureau is working to end the payday debt trap. Our proposed rules would require lenders to determine whether borrowers can afford to pay back their loans. Borrowers can avoid the debt trap when they repay, not repeat their loans. To learn more about our work to end payday debt traps, visit consumerfinance.gov.
Okay, now this next one is very important, your credit history. Just like the little talking credit cards mentioned about your credit and your credit worthiness when they were paying for this $2,000 pizza. At least they were making the minimum payment. So you don't want to miss a payment. Even if you get tight and can't pay it off, you want to make sure you make at least the minimum payment because that affects your credit history. Now, what is credit history? What does it do? It tells businesses basically how you handle your money. Do you pay on time? And these are the things people don't realize that have such a serious impact on your future life and your current opportunities. A lot of times you don't really realize until it's too late. You get, you don't pay on time, you pay when you can, you always short, you're not making that effort, you go to the ball game instead of paying on your credit card, you run it over the limit. You don't feel any immediate pain, but there is pain. It is affecting your credit worthiness. So it tells businesses how much you owe, how you pay your bills, and these things influence jobs, loans, security clearance, and more. This is something a lot of times we don't realize that when you get a job making over a certain amount of money, not only do they do a credit check on you, they do a background check on you as well. So the credit check and the background check can go hand in hand. So if you got a bad credit report, you're gonna have and a good background check, you still gonna have a hard time getting that job. So you want to make sure that you keep these things in mind and you want to get your annual credit report. As it says here, get an annual credit report every year. Review it. They got new rules and regulations that make it easier for you to fix the things that are on your credit report. It is so important for you to do that. Your personal financial manager can help you get your free credit score. And the credit score is called the FICO score. And basically, this determines based on your bill paying habits, how much credit you have. Is a numerical score that they create to determine what you will actually pay in interest. And the higher the score, the lower the interest. So this is something you really want to keep in mind.
Understanding how a FICO credit score is determined. Presented by Econ Lowdown. FICO is a company that uses statistics and mathematical formulas called algorithms to determine a person's credit score. A FICO score is the most common credit score used to determine loan eligibility and the interest rates a person pays. A credit score is a person's financial history packed into a 3-digit number, which indicates a person's credit risk. Your credit score is compiled of information found in your credit report. A credit report is a loan and bill payment history kept by a credit bureau. Financial institutions and other potential creditors use credit reports to determine the likelihood of debt repayment. Credit scoring companies use statistics to determine the risk associated with lending. They do not use data such as sex, age, race, or religion to determine the likelihood of repayment.
FICO and other credit scoring companies are always updating their formulas, but here are the categories that FICO generally includes in the development of its credit scores, with a rough estimate of the emphasis they place on each category. Payment history accounts for roughly 35% of the credit score. The amounts owed relative to credit limits accounts for roughly 30%. Length of credit history accounts for about 15%. Frequency of new credit accounts for roughly 10%. And types of credit used accounts for about 10%. Let's quickly break down each category. Payment history takes into account any bills paid late, including how many are late, how late they are, how recent any delinquencies are, and the total amount owed. This is where people can sometimes find themselves in trouble with credit. The good news is that over time, older entries, including negative entries, disappear from your credit report. Typically 7 years for late payments and 10 years for bankruptcy filings. Amounts owed relative to limits is your debt to credit ratio. Say you have 5 credit cards, each with a $20,000 credit limit. That means you've got a $100,000 credit limit. You may only be using 10% of that, and that's positive. However, if that means you've maxed out on one card, that's negative. It's best to keep your debt to credit ratio below 50%. Length of credit history takes the average length of time you've had your credit card accounts into consideration. The longer history you have of making payments on time, the better your credit score. Frequency of new credit is important because if you have a lot of newly issued credit in your credit history, whether new loans or new credit cards, lenders may be concerned about your ability to repay all of that new debt. Therefore, they will be less likely to lend you money. While examining types of credit used, lenders prefer to see that you are capable of handling different types of credit. So someone who only has credit card debt will probably not have as good a score as someone who has demonstrated good payment habits on installment loans, mortgage loans, and student loans, as well as credit card debt. All of this is important because your credit score affects your ability to rent an apartment, buy car insurance at lower premiums, gain employment, and obtain credit at lower interest rates. That's right, a good credit score will save you money. Here's an example. Kim Min-yo and Lee Soo-young are applying for a $10,000 loan. Both look like qualified candidates. They both live in the same city and work at the same company. Let's see if their FICO score tells the same story. Min-yo pays all of his bills on time and in full. He usually uses about 10% of his total credit limit, and he's had the same credit cards since college. Soo-young, on the other hand, frequently forgets to pay her bills on time. She uses over 50% of her credit limit, and when she maxes out a credit card, she opens a new account. Who do you think would have a higher credit score and, as a result, be more likely to obtain a loan with a better interest rate? That's right, Min-yo would, because his credit score is closer to 800, while Soo-young's is closer to 600. Suppose that Min-yo received a 5% simple interest rate on the $10,000 loan, while Soo-young received an 8% simple interest rate. Over the course of a year, Min-yo would pay $500 in interest, while Soo-young would pay $800 in interest. That's $300 more interest than Min-yo. She could have saved or used that $300 to purchase something else. So your credit score does matter. Let's recap. To maintain a good credit score, pay all bills on time and in full. This way you avoid late fees. Avoid opening new credit card accounts or installment loans. Keep your debt to credit ratio low. Don't cancel your oldest credit cards, as length of credit history is important. And remember, monitor your credit reports. By law, each of the 3 credit bureaus, TransUnion, Equifax, and Experian, must provide you with a free credit report every year. You can obtain these free copies by visiting www.annualcreditreport.com. Remember, each of these reports may vary slightly from the others, so it's important to check all 3. Now you understand a little more about how a FICO credit score is determined. Visit stlouisfed.org and the education resources for more information on credit and other topics. Continuing Feducation, brought to you by Econ Lowdown.
Improve credit. sometimes we have no credit or bad credit. Either way it go, you need credit in our society today, and you need a good credit score. Say for instance you have no credit history, that creates a problem for you getting security clearance, renting an apartment, or even getting insurance. But a way to put a good credit history together is to pay your bills on time and for the full amount. If you don't have any credit cards, or maybe your credit may be a little dinged, get a secure credit card that comes from the credit union or a bank. You actually put money on the card. It's not a prepaid card. It's actually a credit card that you put money on. And the payments you make actually go on your credit report. This will help improve your credit standing. Now, if you have a bad credit history, which you want to try to make it a little better, you might want to look at some things. And these are some items on this slide that I think are very good. You want to explore interest forgiveness. Sometimes company will take off the interest and let you just pay the balance of the principal. That's a good deal. But before you do that, you want to make sure you get that in writing. You want them to send you a letter. Two things you want in that letter: the amount that you're going to pay to get the debt taken care of, and the fact that once they receive the check, they will remove the item from your credit report. I cannot emphasize that enough. Once you get the letter, then you live up to your agreement, because they have nothing to lose by doing that, because if you don't pay, they just leave it as it is. So the next thing you want to do is try to pay down your credit cards, beginning with the ones with the highest interest rate. That's always the best thing to do. But how do you pay them down when you're constantly using them? This is where you're going to have to really rely on, how can I say this, your resources on post. You're going to have to cut back on everything. Basically, I would suggest put the credit cards in the drawer. That's what my financial planner told me. Put the credit cards in the drawer and you just don't use them. Because a lot of times we will pay them down, and when you get the statement and it shows you have $20, $25 available on there, you'll use it. So you'll turn around and pay it, and then you'll turn around and use it. That's the kind of thing that creates a debt cycle. So you definitely want to come up with a way. Go to your PFM, go talk to them and find out what resources you have to cover you for a couple of months, so you can kind of get this thing under control. So you want to make sure you talk to someone to help, like maybe you need food or gas. Go talk to your resources on post to help you get this under control. Because if you pay in your credit card, then you turn around and use up the money, you will never get it paid off. And then the next thing is, do not take out a new credit card because the old one you have is maxed out. Uh, that's a no-no. Then you just adding more debt to more debt. So don't do that. Then you want to keep the old accounts open, because this will show a length of credit history. As you get the bad stuff off and get things cleaned up, this will help your credit score. And then you want to check regularly your credit report. Check it regularly. And I cannot emphasize enough, get help. Go to your personnel financial manager or a certified credit counselor. I would go to the PFM first and have them refer you to a credit counselor, because truth be known, if you deep in this hole, you cannot get out alone, because you're using the wrong techniques to try to get out. Taking care of your credit while you deploy it is very important. There's some steps you should take before deployment. You should plan with your PFM to work out a way to get all your bills paid, work out a schedule and a budget so you can be on point taking care of the bills that you have made. There are ways you can do. You can set up automatic bill pays that will help you take care of some of the time and some of the bills, so you won't have to worry about those that you can use automatic bill pay for. But if you have some that you cannot, then you need to try to come up with some other alternatives. Some of them may qualify for allotment. And then also you could delegate this responsibility to someone you trust, like maybe a spouse or a parent, to access your account to keep an eye on things. And then also you can set up active duty alerts to protect your accounts. This is something you add to your credit report to make businesses take extra steps before granting any form of credit in your name, because military personnel are very much targeted by identity thieves and scams and things, because they know oftentimes you're overseas. So, and something else you can do, you can also research before using credit cards overseas. This is something you should definitely do. Just because the card may be widely accepted, you don't know whether any form of fraud or something else is being used, and the name of the country you're going to find out whether the businesses there are likely to accept your card. So you need to do things to make sure that you're being protected, that your card will actually work. Not only is there fraud issues, but you want to check to make sure your card works in that country.
John's truck broke down, and he needed money quickly to get it fixed. He couldn't get a loan, and his credit card was maxed out. So, John went to a payday lender. To get his $500 in cash, he had to give the lender a check for $575. $500 to repay the loan, and $75 for a fee. John didn't have the money in his account right then, but it didn't matter. The lender would hold the check for 2 weeks until the loan was due. But after 2 weeks, John didn't have enough money to pay back the loan. So he paid the lender $75 more to roll over his loan. That means he got 2 more weeks to repay the loan. And 2 weeks later, the same thing happened. John paid another $75. That bought another 2 weeks to pay back the loan. It took John 12 weeks, that's 3 months, to save enough money to repay the original $500 loan. In the end, John paid $1,025 when he only needed $500. That was a really expensive loan.
Sometimes we have emergencies that come up really quick and we just need money right now. We feel like our back is against the wall and we just get desperate. So you see all of these quick money loan places or car title lending places, and you figure this is your last resort. But you should only truly use that as your last resort. The interest rates on some of these things are like 36% for militaries. So truly it should be your last resort. And then a better alternative would be like the bank or the credit union. And even in this case, you could use your credit card. But if your credit cards are maxed out, then the best option is to look for help within the military. Try your PFM or the DOD Military One Source, and they're open 24 hours, 7 days a week. Now, doing that, using your military resources, you can get immediate medical assistance because you got medical bills covered, so you don't have to worry about those types of things. So if this is like some kind of car or something, or even credit card debt or other loans, the Military Relief Society can help you get those paid. And then also they can help you try to get an extension when the bills are due, and maybe an advance on your paycheck, or even get you with a certified credit counselor to help you figure out what's going wrong with your finances. Many times it's just the things we don't know that keep us in trouble. And someone who can see the bigger picture can help you resolve the actual issue, as opposed to us sometimes just constantly finding ourselves in the fire. This way is a more responsible way to solve the problem, and it's a long term fix.
Albert needed some extra money to pay his bills this month. He saw an ad on TV that said you can get a loan if you own a car. So he went to a local shop that advertised car title loans. Albert filled out an application. Then he showed the lender his car and the title to his car. The lender gave Albert $1,000, but he kept the title to Albert's car. In 30 days, Albert had to repay the $1,000 he borrowed, plus a fee of $250 to get his car title back. But a month later, Albert didn't have the money he owed, so the lender gave Albert more time to repay the loan. But Albert would have to pay another fee of $250. Another month passed. Albert now owed $1,500, but he still couldn't repay the loan. This time, the lender didn't give Albert more time to pay back the loan. Instead, the lender sold Albert's car and kept the money. Albert lost his car and his transportation. He knew it would take a long time to save enough money to buy another car, and he also knew he would never get a car title loan again.
Debt is crushing. Debt is something we create ourselves. As I said a while back, that any form of credit card is borrowing. Debt is subtle in our world today. You don't have to go to a bank to take out a loan anymore to create debt or to borrow. Now you have payday lenders. Now you have car title liens and all these other innocuous ways that we can find ourselves in debt. But once you're in debt, it can be stifling and hard, but there is a way out. And the best way out is training and budgeting. Once you find yourself there, don't borrow money to get out of another debt. Don't take out a credit card to pay off another credit card. You're just adding debt on top of debt. You need a resourceful, legitimate plan for a long term solution. The first thing to do is to cut costs and apply the savings to the debt you're trying to pay off. Next, contact the lenders for help. Sometimes, if you have a loan or a credit card or something, you can contact them and let them know that you're in a financial hardship. And they many times will work with you by maybe, depending on the kind of loan, they may be willing to reduce your monthly payment. But the trick to that is it will extend out how long you will pay the debt. Okay, you got to contact a certified credit counselor. Your PFM should be able to do that for you, to guide you to that person or to someone. The main thing you want to do is to make sure that that person is qualified to work in the state. They don't charge you money up front. You know, you want to ask a lot of questions to be sure that you're getting the actual help, and you want to be clear on what services they provide and how much will it be the cost at the end of the various sessions. And you know, do you have free education or information? These are things you should definitely ask. So the main thing when you're dealing with a credit counselor is to understand they're not going to get rid of your debt. They got going to wipe it out. The best thing to do is to let them work with you to not only eliminate the current debt, but teach you ways to stay out of debt. So you want to look into the counselors, evaluate what they say, you know, find out what their services are, their costs, and any kind of free benefits they offer. You want to make sure that it's confidential and they're licensed. So you know, I can't say enough about the frightening influence of debt. I've experienced that. I had to go to a credit counselor back in the 80s when I found myself in debt above what I was making, and I really did not know how to manage money. That's why I really enjoy doing this portion of the video, because the only way is learning and training and learning how to manage your money. You can't just buy everything you want. There are consequences. You actually have to live within your means. So whether somebody's offering you something new, it just creates more debt. You cannot debt your way out of debt. It doesn't work. When I went to the credit counselors, it was free. The service was free. They worked out me a budget plan. They helped me to understand what was going on. And I actually paid for classes on learning how to manage money. I paid $300 for this seminar, and the books and the tapes and the training, and being able to call the credit counselor to help me understand how to manage my money. So it's a frightening thing to find yourself with a good job and you still are struggling and you still stressed about debt. That's why I do not do store credit cards or all of these little things. I don't buy stuff on credit. I believe in layaway. And I had a good job and I lived like that. I would not buy a new car. I own one new car in my life. I kept older cars and I kept them running. I took good care of my cars, take care of the engine and everything. So it's so important to manage your money, because debt will kill you, and the only way out is training.
In uncertain times, what can you be sure about? The sun rises in the east. What goes up must come down. Night follows day. Well, here's something else. When it comes to dealing with debt collectors, federal law gives you rights. For example, debt collectors can't call before 8 in the morning nor after 9 at night. Can't curse or insult you. Can't demand that you pay more than you owe. Can't lie about anything. They can't say that papers they send you are legal forms if they're not. Nor can they make up consequences for not paying your debt. And they can't call you at work if your employer doesn't allow it. You also have the right to stop debt collectors from calling you. How do you do that? You have to notify them in writing. Sending them a letter should stop the phone calls, but of course, doesn't wipe out your debt. There's helpful information about dealing with debt at ftc.gov/moneymatters, a website from the Federal Trade Commission. It explains the rules of behavior for debt collectors. Take a look. There are some that may surprise you. If your debts have gone into collection, remember that you have rights. Asserting your rights doesn't make your debt go away, but it does give you a voice. The more you know about how to manage your debt and deal with debt collectors, the better off you can be. After all, money matters. If you think that a debt collector has violated the law, report it. File your complaint with the Federal Trade Commission at ftc.gov/complaint. Your complaint gives law enforcement a lead to follow up on and may stop it from happening to someone else. The Federal Trade Commission is the nation's consumer protection agency. For more tips on credit and debt, visit ftc.gov/moneymatters or 1-877-FTC-HELP. 1-877-382-4357.
As you can see, you have rights dealing with debt collectors. The debts we make, people have a right to get their money back, but there is a process that they have to follow. They, as you saw in the video, they cannot use abusive language and all this other crazy stuff. They cannot tell lies or anything. But if one of them contacts you, you want to take notes on the conversation. You know, if you want to ask for written notice, don't accept harassment. And then the main thing to do is to talk to a certified credit counselor. Like I said in the previous section in the slide, that's your best option. And as a military person, take advantage of the wonderful services you have on base. Go to your PFM or legal services. Please don't get offended when people are telling you, you need to change your spending habits and all of these things. You cannot make a debt and not have to pay it. And getting out of the military, the debt will still follow you into the private sector. And it can be even more so horrendous because you won't have the services you have in the military. So make sure you work these things out. And if you get a summons, look at the details. Go to the PFM or the legal services, but the most important thing, you must show up in court because they will render a judgment against you. So debt is horrible. And like I said, the only way out is with help and self-control and learning the proper skills of managing your money. Thank you for watching part 3 of the Military Consumers Toolkit on Borrow. The next part is part 4, which is Save and Invest. Look forward to seeing you there. Have a great day.